Every investor has felt it. You click buy at a price you saw on screen, and the fill comes back worse. You place a tight stop, and it gets tagged to the penny before price reverses. You try to sell into strength, and the market vanishes like a mirage. If markets are supposed to be efficient, why do so many trades slip through your fingers? The answer isn't bad luck or a shadowy cabal flicking switches in a basement. The answer lives in the pipes. Slippage is not a glitch. It's the toll you pay to travel a road built by auctions, queues, and algorithms that value speed the way a drowning man values air. This is the part people miss. What you see on the screen isn't the market. It's a reflection of the market, delayed by cables, filtered by matching engines, and framed by rules that reward those who arrive first and know more. Under every flashing quote is an auction that never stops. If you follow the gears long enough, exchanges, dealers, wholesalers, dark pools, you discover something unsettling. There isn't one market. There's a federation of marketplaces stitched together by legal mandates and economic incentives that T always line up with your best price. Pennies become profits. Milliseconds decide who survives. And you, the well-meaning trader with a plan, are stepping into that auction with a sign on your back that says how badly you want to trade. To see why trades slip, we have to go back to the beginning, before the screens, before decimalization, before clever order types with cheerful names. Picture the old pits, human beings in colored jackets shouting, gesturing, stacking paper. Prices formed as a live auction in the most literal sense. Bodies in space negotiating value. The rules were simple. Price priority. A better price beats a worse price. Time priority. At the same price, whoever arrived earlier gets filled first. You could see the crowd thin out. You could see the size. And when you were late, you were visibly late. Fast forward to the modern market. The shouting is gone, but the auction never died. It moved into silicon. We still operate on price priority and time priority, but time is no longer measured in seconds. It's measured in microseconds. What used to be elbow position in the pit is now rack position in a data center. And the first place your trade slips is the queue. When you submit a market order, you jump the line, you pay the spread, and often kick the price as you chase available shares up or down the book. When you place a limit order, you join the line. You get in at a level, but you might be so deep in that line you'll never see a fill. The market isn't trying to hurt you, it's obeying its own laws. You were experiencing the consequences of a rule set that extracts rent from urgency and rewards patience with priority. Look at the screen and you see a price, but that price is really two numbers, the best bid and the best offer, with a spread between them. That spread is the rent for immediacy. Want to trade right now? Pay the spread. Willing to wait? Try to earn the spread by posting, but the screen is a mirage. The top of book might show 100 shares, yet beyond it sits a ladder of hidden size, pegged orders, and conditional logic you'll never see until you hit it. Some orders are icebergs. I'm showing a tip while hiding the bulk beneath. Others are hidden or pegged, floating at mid-price or at a tick off the quote, revealing themselves only when nudged. When you lift the offer, you're not buying a static object. You're changing the state of a machine. Quotes update. Queues reshuffle. Other algorithms react to your touch. The market you hit is not the market you receive, because the moment you act, the order book becomes a different book. Now consider adverse selection, the quiet engine of slippage. Liquidity that wants to trade with you immediately usually thinks it has a reason. If your order arrives in a way that looks informed, arriving after a price breakout, clustered at a level everyone is watching, sized in a pattern that screams urgency, your counterparties infer you might know something. What do? They step back. The visible book thins, passive orders pull. The next quote widens. You chase the ladder and your fill deteriorates. That S adverse selection. The tendency for liquidity to demand payment when it suspects the other side has an edge. Makers want compensation for the risk of being picked off. Takers pay for the right to move. Your order's toxicity, its ability to predict the next few seconds of movement, changes whether the street leans in or runs away. Slippage isn't just about you. It's about how you look to the machine across from you. And then there's speed. In the pits, time priority meant how close you could shove your body toward the broker. Today, it means how close your server is to the matching engine, how fast your network path is, how quickly your risk checks pass. Firms pay for co-location space inside exchange data centers to trim microseconds off round trips. They build microwave relays between cities to outrun fiber's slower path. They refine code to shave nanoseconds off decision loops. If you can update faster, you earn queue priority for free. You can post at the front of the line, cancel when the wind shifts, and re-enter a few microseconds later, still ahead of slower rivals. If you're not co-located, every hop between you and the engine is another chance for the quote you saw to vanish. You click buy, your order travels through routers and gateways, and by the time it reaches the book, the price has changed. That gap between what you saw and what the engine knows, that's slippage. It's not fraud, it's latency. And latency is a tax paid by everyone who isn't fastest. Dry joke. In markets, speed is like oxygen. You only notice it when you don't have it. Your next invisible cost is market impact. Imagine pushing a boat into a quiet lake. The act of pushing creates waves. Large orders create larger waves. Impact comes in two flavors. Temporary impact moves price while you trade and then mean reverts as your footprint fades. Permanent impact remains because your order told the world something true. Someone with information or size wanted that stock. Now the equilibrium is different. If your trading pattern screams urgency, spraying aggressive child orders across multiple venues in a bursty rhythm, every listening algorithm hears you. They widen. They fade. Some will race ahead to avoid being the next one picked off. You pay for the ripples you make, and if you don't measure them, you'll never know whether the slippage you blame on the market was actually your own shadow. We should also talk about fragmentation, the modern market's favorite trick. There isn't one exchange. There are many. There are lit venues where quotes are displayed and depth is visible. There are dark pools where orders match at or near mid-price without revealing size. There are wholesalers who internalize retail orders, paying brokers for the privilege because benign flow is valuable to trade against. Each venue has different economics and different rules. Lit markets are great for discovery and for small opportunistic clips. But when you lean too hard on the lit book, you move it. Dark pools are great for size and discretion until toxicity spikes, and you discover you've been matched with the other side of every bad idea in the building. Internalizers may give price improvement in quiet times, but your flow may never contribute to discovering where the real price is. Routing becomes a chess match. Send too much to lit, and you announce yourself. Send too much to dark, and you miss the moment. Spray across venues in a predictable sequence, and you telegraph intent. Wait for opening or closing auctions, and you can trade in deep liquidity, but you surrender control over timing. Slippage isn't just how much did I pay, it's where did I fight the battle. ICE. Order types are the grammar of microstructure. Use the wrong grammar and the machine misreads your sentence. Market orders say, fill me now, I'll pay. Cheap, only if you value time more than price. Limit orders say, fill me on my terms. Cheap, only if you accept the cost of waiting, the risk of missing, and the possibility of being picked off the moment you're finally at the front. Stops provide insurance that transforms into a market order the moment a level prints. In fast moves, stops don't trigger at the price you imagined. They execute at the price the book can supply, which may be many ticks away. Pegged orders ride the, quote, useful when the book is stable, hazardous when quotes flicker in and out like fireflies. Reserve and iceberg orders hide your true size to reduce signaling. But every time your displayed slice replenishes, you can lose precious time priority to faster replenishments nearby. IOC and FOK reduce partial fills, but they increase misses and can leave a trail across venues that others follow. Designer order types, discretionary pegs, hide not slide, queue jumping variants with arcane names, promise advantages that vanish if you don't understand the contexts they were built for. The market fills the order you wrote, not the trade you imagined. Precision doesn't eliminate slippage. It chooses the kind of slippage you're willing to pay. History has already shown what happens when microstructure meets stress. Think about the day the market AS heart skipped a beat in 2010. A large sell program met a thin, nervous order book spread across many venues. Liquidity didn't evaporate into thin air. It ran for the exits. Quotes widened. Orders canceled. Matching engines did exactly what they were told to do, and prices air-pocketed. If you needed to get out in that window, you didn't get the price you clicked. You got the price the pipes could handle while the crowd tried to remember which way was up. Or remember when a central bank removed a currency peg in 2015. Quotes became decorations. Dealers pulled, spreads exploded, stops cascaded through thin books. In moments like that, time priority gives way to survival priority. No order type protects you when every participant reaches for the same doorway. And then there were those months when meme stocks turned the street upside down. Payment for order flow, internalized retail flow, limited borrow, and throttled venues collided with human hope. If you tried to trade the crest with a market order, you paid the price of popularity. A book too thin to catch you and pipes too stressed to deliver the number your phone promised. Strip the mystique, and the reasons your trades slip sound almost banal. You paid for immediacy, so you crossed the spread and ate through the book. You arrived late to a fast quote, and latency took its cut. Your order looked informed, so liquidity stepped back. You signaled size, and the machines widened in self-defense. You used blunt tools in surgical conditions. You fought in the wrong pool. You traded at the wrong time, at the open, during news, into a holiday close in the midday desert when a single clip can move the whole ladder. Or you underestimated the queue. The price touched your level, but you were far back, and someone else collected the fill. None of this is an indictment. It's a diagnosis. The rules reward those who supply patient liquidity and those who manage information precisely. Everyone else pays the toll. So the question becomes practical. If you can T abolish slippage and you can T, how do you choose which slippage to pay? Start by defining urgency like a grown-up. If timing matters more than price because you re-hedging risk or closing a position that can add to drift, accept that you're buying immediacy and budget for it. Don't pretend a market order is cheap. If price matters more than timing because your thesis plays out over days or weeks, become the person who gets paid to wait. Post at edges where you're genuinely happy to transact. Let others pay to cross to you. Slice intelligently. Benchmarks like VWAP, TOAP, and POV exist for a reason. They turn a big rock into digestible pebbles and help you hide among the crowd. But they are scaffolding, not a sovereign. If you outsource your brain to a schedule, you'll be taken for a walk by every liquidity mirage. Override when real size appears. Pause when the book goes thin. Hunt for natural crosses, rather than stamping the same footprint across 10 venues in 5 seconds. Hide your intent. Randomize child order sizes and timing. Break the habit of sending the same 2,000 share clip every 30 seconds. Use reserve size so you don't paint a billboard with your true appetite. But remember, every layer of disguise trades off against priority. The more you hide, the more you risk standing behind someone faster when the moment finally comes. Choose venues deliberately. Use lit markets for discovery and small, opportunistic trades where you can step inside the spread. Use dark pools for blocks when toxicity is low and you've measured outcomes over weeks, not anecdotes over lunch. Internalized fills can be fine for non-urgent retail-type orders, but don't expect them to teach you where the real price is. Auctions at the open and close offer astonishing liquidity. They also compress risk into a single minute where prints can surprise you. Root with intention, not superstition. Respect the clock. The open is liquid and violent. Spreads are wider. Depth is unreliable, and your stop is a chew toy in a room full of dogs. Midday is calm and thin. A single trade can move the ladder like a gust through dry leaves. The close is deep, but emotionally charged as funds rebalance and benchmarks loom. News is chaos. Quotes flicker, gateways throttle, and the next print can be a vacuum. If you must trade in those windows, design your orders for that weather. If you don't have to, choose better weather, mind the queue, improve your limit by a tick when it earns front-of-line status, but don't a T-chase in a way that buries you behind a 1,000-lot wall that will never clear without your help. Every improvement costs you. Sometimes the right answer is to wait just below a crowded price and let impatience donate fills to your level. Sometimes the right answer is to step up and pay to end the uncertainty. Discipline is knowing which mountain you're climbing and how much oxygen you brought. Measure impact like a scientist. Track implementation shortfall, the difference between the price when you decided to trade and the blended price of your fills. Break it down into spread, delay, and impact. If your footprint is consistently permanent, price does not revert after you finish. You're informing the street with your behavior. Change the behavior. If it's mostly temporary, price snaps back when you redone. You're repaying a liquidity premium that might be reduced with better slicing and routing. And what gets measured gets managed. What gets hand-waved becomes a superstition. Know your edge with humility. If you don't have speed, don't try to win speed games. You won't. If you don't have information, don't bluff with size. You'll advertise a bad hand and pay when the table leans on you. If your edge is selection over days and weeks, build workflows that spend as little as possible on seconds and ticks. If your edge is immediacy and stress, accept that your P&L lives in the spread and slippage and design for resilience rather than beauty. There's a darker truth here, and it's simple. Markets promise fairness through rules. Microstructure delivers fairness through mechanics. Mechanics don't care about your feelings. They care about priority, latency, queue position, and information quality. The line between liquidity provider and information predator blurs at microsecond scales. A maker earns rebates for sitting there until it cancels a microsecond before your order would have hit. A taker pays fees for immediacy until it decides to be patient and penny in front of you with better time priority. Democracy decides who governs. Markets decide who survives. Survival belongs to those who understand the hidden auction running beneath every quote. Slippage isn't an accusation, it's a bill. The system doesn't steal from you, it charges you. It charges you for speed you don't have, for information you don't possess, for urgency you don't truly need. It charges you for pressing your face against the glass and demanding service from a machine that was never built to be a vending machine. And here's the punchline. Once you accept that cost, you regain agency. You can choose the hours when you trade. You can choose the pools you fight in. You can choose the punctuation of your orders and the tempo of your execution. You can decide which part of the toll you pay and which part you get paid to collect from others. So the next time your stop gets tagged to the penny and price reverses, don't curse the gods. Ask what you told the machine about your urgency. Ask whether you placed an insurance policy in a hurricane and expected it to be honored at yesterday SI premium. The next time your limit sits unfilled while price grazes your level, don't declare conspiracy. Ask where you were in the queue, whether you surrendered priority to hidden replenishments, whether a tick of improvement would have put you in the only seat that mattered. The next time your market order spills down the ladder like a bucket on stairs, ask whether you demanded immediacy when patience would have been cheaper, or whether size would have been safer in the auction at the close. Treat the market like an auction, not a promise. Choose your urgency. Choose your venues. Learn the grammar of orders until it's muscle memory. Measure your footprint until the myths fall away and only mechanics remain. Accept that slippage is part of the price of participation, and then get paid where you can, when you can, for the patience and information you actually possess. The market you see on the screen is an invitation, not a guarantee. If you act like it is, the machine will teach you how much guarantees cost. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.